Australia is stuck in a macroeconomic rut of low real growth.
Australia's housing crisis is the worst it's ever.
In 2025, a quiet crisis is brewing in Australia. For a long time, it felt like a dream, a lucky country with beautiful beaches and endless chances. But what's the real story? Why is a nation that had everything now facing a slow collapse?
Cut out on maybe going to the theatre or the movies a little bit more and only spend on essential things.
Today, we're going to break down the 4 pillars of this coming collapse so you can see the truth that's been hiding in plain sight. First, let's understand the current situation.
Despite rising interest rates, Australia's economy continues to grow.
On the surface, Australia's real GDP looks like it's growing, but that's not the whole story.
So right now we are in a GDP per person recession. Big part of the reason why people feel poorer.
In fact, for 7 quarters in a row, the country's per person GDP was negative. This means that even as the total economy got bigger, the economic pie for each person was shrinking. This period was so bad, it was called a per-capita recession.
Headline inflation figure has fallen to 2.1%.
Inflation is also finally slowing down. The annual Consumer Price Index, CPI, is at 2.1%, and the underlying inflation rate, known as the trimmed mean, is at 2.8%. That brings it closer to the RBA's target range of 2 to 3%. The job market is also strong.
Australia's unemployment rate unexpectedly dropped to 4.2% last month, its lowest level in over 13 years.
With the unemployment rate at a low 4.2% as of July 2025. The headlines might scream about low unemployment and slowing inflation, but those are just a small part of the story. Beneath the surface, the Australian economy is facing 4 major problems that are quietly eating away at its future.
Australia's housing crisis is the worst it's ever.
In a new housing crisis spreading across Western Sydney.
Sydney is now the most expensive, least affordable city on the planet.
First, let's talk about the biggest problem affecting the daily lives of Australians, the housing crisis. The country is simply not building enough homes. In 2024, the country only completed around 177,000 new homes, but it needed 223,000 to meet basic demand. The gap between supply and demand is huge. The reasons for this are a perfect storm of problems.
Rising construction costs, though, have driven up the price of new builds.
New report today says labour shortages continue to hinder the industry and more companies are going broke.
A shortage of construction workers, rising costs, and a slow, complicated approval process.
Home building approvals dropped to 20-year lows. It's the sharpest drop on record. The January building approvals were 27.6% lower than December, 8.4% lower than January last year.
The number of new building approvals has been at a 10-year low, which means the problem will not be solved anytime soon. This has led to a major housing crisis, with vacancy rates in major cities being extremely low and rents skyrocketing. The government's recent decision to place a 2-year ban on foreign purchases of existing homes is a notable policy change, but its effect on overall prices is expected to be limited since foreign buyers make up a small part of the market. This systemic lack of supply means housing costs are eating up a huge part of people's income, hurting consumer spending and even affecting birth rates and people's ability to move for work. It's a problem that affects every part of life.
Obviously, China is Australia's biggest trading partner. That's not going to change anytime soon.
Next, let's look at the economy's shaky foundation, its heavy dependence on China. About 1/3 of all Australian exports go to China. The biggest risk is the lack of diversity in what is exported. A huge 60% of Australia's exports to China is just one thing.
Stockpiles of iron ore very high.
Iron ore. This means Australia's economy is deeply tied to the health of China's real estate and construction sectors.
Well, it's really the oversupply of property in China, and that's reducing the demand for Australian iron ore.
Our biggest trading partner is in the middle of a very different housing crisis.
If China's economy slows down, the price of iron ore will fall. This would hurt Australia's income, tax revenue, and jobs all at once.
Behind iron ore, coal and gas, international education is Australia's fourth biggest export.
We hear a lot about Australia's whopping $40 billion of education exports and how the sector is the biggest product we export that we don't source from the ground.
While some service exports, like education and tourism, are recovering strongly, with education exports reaching around 51 billion Australian dollars in 2023 to 2024, the risk of relying so heavily on a single product remains. However, Australia is starting to diversify its exports to other countries like India and ASEAN, which is a crucial step towards a more stable future. But until that happens, its economy will remain fragile.
Apart from house prices, Australia's biggest economic problem is the shocking decline in productivity.
We've seen the biggest and steepest fall in productivity levels in our nation's history.
Now, let's get to the root of the problem, a lack of productivity. Productivity is a simple idea. It's how much value each worker creates per hour. It's the single most important factor for a country's long-term wealth. And in 2022 to 2023, Australia's labour productivity shockingly fell by 3.7%, the biggest drop since records began.
And investment as a share of GDP in Australia has been declining and is at very low levels historically.
We're not getting what the economists call the capital deepening.
In a dynamic economy, investment is important and capital deepening is important for securing productivity growth.
This isn't just a number, it's a symptom. It tells us that businesses are not investing enough in new technology and better equipment for their workers. This is called capital deepening. Imagine a carpenter trying to build a house with old, rusty tools while their competition has powerful new machines. The carpenter can work hard, but they won't be as fast or as effective. This is what's happening to the entire Australian economy. The result is that your real wages don't grow. Your purchasing power gets weaker, and your standard of living stalls. To fix this, Australia needs to invest more in technology and innovation. Without that, this slow, long-term economic stagnation will continue. But the real story is that this productivity crisis is making the next problem even worse. Finally, this lack of productivity is made worse by another major issue.
Millions of Australians are heading into the new year carrying an alarming level of personal debt.
If going into debt was an Olympic sport, Australia would have a lot to be proud of. We're gold medalists at taking out loans.
Australia's high household debt. Australians have some of the highest levels of debt relative to their income in the world, at around 180%.
We have about a $1 million mortgage. We feel okay about it. It's not great.
This is a huge risk because a large portion of these loans are on variable or short-term fixed rates, which means that interest rate changes hit people's finances very quickly.
Their repayments will rise by about $1,000 a month.
Pretty nervous. It's going to be really tight.
We saw this during the rate hiking cycle, where thousands of households on low fixed rates faced a mortgage cliff, with their monthly payments suddenly jumping by hundreds or even thousands of dollars. The debt service ratio, which is the portion of income used for debt repayments, has climbed significantly.
So as you know, today the board decided to cut the cash rate by 25 basis points to 3.6%.
The cash rate being cut from 3.85% to 3.6%.
While bank data shows that mortgage delinquencies are rising, they are still historically low. This shows that despite the financial stress, many families are cutting back on everything else just to keep up with their loan payments. The RBA has started to cut rates, with 2 cuts of 0.25% in May and August 2025, bringing the cash rate to 3.60%. This will help, but because the original loan amounts are so large, the pressure won't disappear overnight. This debt is like a chain on the entire economy, holding back consumer spending and growth. All of these problems are connected in a vicious cycle. The productivity crisis means wages don't grow. This makes household debt harder to manage, forcing people to spend less. At the same time, the housing crisis eats up a bigger part of people's income, which also slows down the economy. And all of this is made more unstable by the dependence on a single foreign market. It's a powerful loop where each problem makes the others worse, creating a slow, quiet decline that's hard to stop. But there is still hope. Australia is not facing a sudden collapse, but the slow, quiet decline is very real. The 4 pillars we've discussed are the biggest challenges. The question is, can the country fix them before it's too late? What do you think is the most important problem for Australia to solve? Let us know in the comments below. And for more deep dives into the global economy, click on our next video.